So your latest report was what, 24% expected return? That was a few days ago, so I imagine it's at 20% now. That's what index and why?
That's for MSCI China.
Okay, and why?
Now, I think if you take a step back, David, now, I think China had a very good quarter in the second quarter, right? Particularly in the latter part of the second quarter,
yes.
Outperforming S&P by 20%, right? That was the best 3-month outperformance period versus the S&P over the past decade. So we were off from a very high base in terms of relative performance. Now, as we all know, since July, the market has corrected about 8% on the back of a number of concerns regarding the domestic property market, the banking system, COVID situation, and now, of course, the geopolitical tensions regarding Taiwan. But if you take a step back and think about the macro story, I don't think it has changed a lot over the past few months. Essentially, I think China sits on the right side of the equation when it comes to the 3 macro cycles that investors are very concerned about or very focused on. Now, number 1, growth. Now, we think on our forecast, we still think that China kind of sequential growth is going to improve over the next few months. Whereas for the rest of the world, it seems like the growth momentum is going to further moderate from here. And then secondly, on inflation, which is definitely a big topic right now across the globe, inflation remains relatively well contained, I would say, in China based on the CPI print that we just got 2 days ago. And then that leads to the third point, which is policy. I think we can debate about the magnitude of policy easing in China, but clearly Chinese authorities are easing policies pretty aggressively, whereas for the rest of the world, governments, central banks are still tightening, right? So I think when you think about this macro setup, we still believe that the risk reward, especially considering where we are on valuations, MSCI China is trading at 10 times PE. So we think the risk reward here looks pretty compelling.
Do we look through, I think we're about 10% through earnings season on MSCI China. Do we look through the 90%? Because most of that will probably be quite bad because that's the second quarter.
Right. I think the first half interim results season will be, I would say, I don't want to use the word bad, but it will be not very inspiring.
Modest.
Right.
Modest.
That's a good word.
Okay.
So as you said, about 10% of the market cap has reported. So far, it's down 4% year on year. But I don't think this is a surprise to investors given we had close to 0% GDP growth in the second quarter, right? But on a more forward-looking basis, we are still maintaining our below consensus views on earnings. We just, in fact, 2 weeks ago, we cut our numbers further from 4% growth to 0% growth this year. And consensus still sitting at about 7%. So I think earnings risk, to your question, I think is still on the downside. But I would say, though, the risks could be more concentrated in the property-related cohorts, like developers, banks, and some of the material sectors. But if you look at TMT, for example, it seems like the earnings momentum trend is kind of improving somewhat.
And Kendra, you did mention the 3 pillars of maybe what could be driving a rebound in Chinese stocks is the policy side. And I wonder what policy is most important to you? Is it more about hearing about the tech regulation and perhaps we've heard the last of it? Is it about property, or is it, at the end of the day, zero COVID, the biggest policy of all?
So Yvonne, the framework that we've been using to analyze Chinese policy is one where we categorize all these different measures into 5 key buckets: monetary, fiscal, property, industry regulation, and COVID-related policies. Now, I think you touched, you mentioned a lot of them already, but that's the framework, how we think about things. Now, and in terms of which one is more important, I think they're all important when it comes to growth consequences and how we think about the growth outlook from here. So, and I would argue that broadly speaking, we are seeing quite visible easing momentum across these 5 cohorts. And at least for the rest of the year, we still believe that the regulation intensity is going to moderate from here, which should bode well for the TMT sector. On top of that, fiscal policy, we think will be doing a lot of the heavy lifting in terms of providing growth support to the economy.
Okay, you mentioned TMT tech. Is that the biggest pick of all in terms of what could outperform the second half? What other sectors look good to you?
Yes, we're still maintaining our overweight recommendation on the 2 important TMT-related sectors, media and online retailing. Again, I think the top-down story here is that we think the regulatory tightening cycle is going to improve from here in terms of the level of tightening intensity as well as the transparency of regulation. And if that's the case, I think investors will be in a better position to price out the left-tail risks embedded in the pretty depressed valuations for the TMT stocks at the moment. On top of that, as I talked to David, it seems like the earnings momentum trend is improving somewhat for the TMT stocks.
Well, and the opposite of that, which you mentioned earlier, is property, right? And everyone seems to be taking property, dumping it in one basket and throwing it out the window. Are there any gems there, undervalued gems, you think, within the property sector to watch? I
think definitely the top-down sort of sector beta remains difficult, but within that space, we've been maintaining our view that we prefer SOE developers over private developers for obvious reasons, right? So I think there's still relative trade opportunities in that sector.